I think fees matter less, and looking inside the portfolio should matter more. And for those of you that are watching this, and I encourage people to watch this.
All right, joining me will be Aakash Doshi, Global Head of Gold Strategy at State Street Investment Management, who, of course, offers the world's most popular physical gold ETF, the Spider Gold Shares, ticker GLD, which now has over $130 billion in assets. They also offer the Spider Gold Mini Shares, ticker GLDM, which that isn't too shabby either, over $22 billion in assets. But gold itself has had an absolutely stellar year. It's up about 55%. It's sitting right at a record high of about $4,100 an ounce. And you can tell ETF investors are noticing because gold ETFs have taken in a record $37 billion this year, which that's already eclipsed the annual record set back in 2020. And so Aakash and I are going to have a full conversation around all of this. We'll go in depth on what's been driving the price of gold recently. We'll cover a number of the reasons why Aakash believes this run from gold can continue. And then we'll also touch on gold ETFs and the role of gold in a portfolio. And this won't surprise anybody. I may also try to sneak in a question on Bitcoin as well, simply because I can't help myself. And I am just curious how Aakash views quote unquote digital gold. So we'll do that in a bit. To start this week, I'll be joined by Todd Rosenbluth, Head of Research at VettaFi, who I'm not sure some people realize, or maybe they don't fully appreciate, that VettaFi has a very interesting indexing business. They're an index provider, and they actually support over $70 billion in assets through their indexes. $70 billion, including some pretty popular ETFs. And so Todd and I are going to delve into that business a little bit. We'll talk about some of the innovation occurring here. And then as part of that, we'll also spend a few minutes discussing thematic ETFs, which I'll tell you, those are having a great year overall. Some $36 billion in inflows into areas such as artificial intelligence, nuclear energy, infrastructure. It's been a strong year for thematic, so we'll get into that as well. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. All right, let me now welcome in the one and only Todd Rosenbluth. Todd, it's always a pleasure. How have you been?
I've been well. How are you?
I'm doing fantastic, and I would like to take this opportunity to wish you a happy 50th birthday. I saw you had a lot of festivities and celebrations last week, so happy birthday to you.
Thank you. As people who know me, I'm not shy about me. And so I figured if I'm going to do something, I might as well let people know I hit 50. And then we were in Ann Arbor, my wife, my son, and I, to see Michigan win a football game that weekend, which was great. So go blue.
Okay, so on the note of ETFs, you and I cover a lot of ETF topics together on here, and we're going to do that again this week. But I'm going to actually let you bask in the glory a little bit, since it is your birthday celebration week, because we're going to do this through the lens of VettaFi indexes. And I can already see you smiling there. Like I said, I'm not sure people realize just how large this business is. And you look, it's really expanded over the past several years. And I'll tell you, this popped up on my radar a couple of weeks ago when I saw that VettaFi acquired a suite of indices tracking nuclear energy and uranium mining companies. So these were from Range Fund Holdings and North Shore Indices. And we'll talk more about that later. But currently, again, I do show VettaFi indexes are supporting over $70 billion in assets. So do a little victory lap for us here. Tell us more about VettaFi indexes.
Sure. So VettaFi as a company as a whole was formed about 3.5 years ago when a couple of indexing businesses was brought together with the distribution efforts of ETF Database and ETF Trends. And if we fast forward a couple of years, we were acquired by the TMX Group, which is a global financial services firm based in Canada. And you're right, our indexing efforts has now swelled to over $75 billion following the acquisition. We've got some indices that are 10 years and plus older than that, We've got some newer index products as we continue to innovate. And there's just a lot of things that are happening behind the scenes and front of scenes that people probably aren't familiar with, because I'm here talking about the overall ETF industry on a regular basis. But so let me just throw a few ETF examples out to you. The Alarian MLP ETF, AMLP. The Alarian MLP ETF, the ETF itself just celebrated its 15-year anniversary, and it did so with more than $10 billion. The Victory Shares Free Cash Flow ETF, VFlow, launched just over 3 years ago, and it's approaching $5 billion in assets under management. American Century has an ETF, QGrow, that recently crossed $2 billion. And you're right, we recently acquired nuclear indices that pair very well with our Robo Global suite of products that we bought the index efforts a few years ago.
Yeah, you touched on a lot of the ETFs that really jumped out at me that are powered by VettaFi indexes. I mean, AMLP, VFlow, QGrow. You have the Robo Global family of indexes, SDOG. There are a number out there that I think a lot of listeners would certainly be familiar with. Let me ask you this. You were alluding to this. I think many investors understand the indexing business at a high level, just from the standpoint that there are thousands of ETFs and mutual funds out there that are tracking various indexes. And they know that that's different than, say, traditional active management, where you have a fund manager selecting holdings. But can you elaborate a bit more on what an index provider actually does? Because to what you were saying, there is a lot that goes on behind the scenes here.
You're right. So at VettaFi, we help to build new indices and support existing ones. So some of our clients come to us with a fully baked idea and want us, our team, to formalize the rule book and execute on it. Others come to us with a one-word idea that's often thematic, and they want to see what we can do for that, how we can think through liquidity, turnover, regulations, how we can do a back test using our tech stack. We can do things really fast with this systems that we built, and we're using third-party data. A lot of firms are not doing that. So I think that's an advantage that VettaFi has, our technology capabilities. Now, for existing ETFs, we're doing a lot of the plumbing that's behind the scenes, handling corporate actions. We're making sure that the companies that are, or the stocks that are inside the portfolio, if this is equity-based, are still fitting the criteria of the index methodology. That's often during rebalance activities that happen quarterly. Now, some indices are very formulaic. The rules just are run and it's very simple. And other efforts are done with more of a research intensive effort. But VettaFi is also differentiated as an index provider in part based on the work that myself and my research and editorial colleagues are doing. We're supporting our index partners through educational articles. We're hosting virtual events. We're collecting and sharing data on our traffic to our index partners. Nate, as you know, there's more than 4,000 ETFs. It's a very crowded marketplace. And I like to think that we help our index partners to stand out within a crowded space. And at the same time, I and my peers are still covering the rest of the industry.
Well, I love the way you laid that out, because I do think some people think you put an index out there and it's sort of set it and forget it. Once it's out in the wild, there's nothing else to do. And I love that you hit on some of the behind the scenes activities like handling corporate actions and rebalancing, and you have to implement the weighting rules. There's a lot that goes into that. And then beyond that, there is this education component that you touched on, and helping people know that this exists and help them understand why this exists and how it's being used. So I think that's a great description. Let me play devil's advocate a little bit here, which I love to do. So you probably know this is coming. Okay. So one of the narratives that is out there right now, and actually, Todd, I've probably been at least somewhat guilty of perpetuating this myself, but there's this narrative that indexes are boring, that this isn't really where a lot of innovation is occurring. And I think this narrative comes from the fact that pretty much all of the plain vanilla indexes are spoken for, right? There's really not room to create another market cap weighted large cap US stock index. That space is saturated. And I think some would say that a lot of the smart beta indexes are spoken for as well, just in that there are only so many iterations of, say, a value-based or dividend-based approach that you can have. And then I would add to that the rise of active ETFs, which active ETFs are eating up some market share. You and I have talked a lot about what's going on in that space. And so you sort of add all this together, and some people might conclude that there's not much innovation occurring in indexing. Now, I know you completely disagree with that, but elaborate for us. Like, why is that narrative wrong?
Well, I don't completely disagree with it, but two things can be true at the same time. We can have a lot of active ETFs, and there can be innovation happening within the indexing world. So I touched on earlier VFlow, that very popular, nearly $5 billion Victory Shares free cash flow ETF. Well, at the end of last year, we, with our support of our indexing efforts, helped Victory to launch a growth version of that ETF, GFlow, so a more growth-oriented free cash flow effort. And then in 2025, two international strategies came to market. So taking that free cash flow efforts, but bringing it into Europe and Asia and other markets. And those tickers are GRIN and iFlow. So many people think of the Russell 1000 growth and the Russell 1000 value as their benchmarks. And they are good benchmarks for active management, but they're not great investments necessarily. It's a pretty rude and crude way of taking the 100 largest companies, slicing them up on a couple of characteristics. And so we think from an innovative standpoint, VettaFi helped to bring something new to that space. In September of this year, our index behind private credit was launched by Simplify. There's an ETF now, PCR, that's using business development companies and fixed income focused closed-end funds. And then speaking of income, we at VettaFi bought the Credit Suisse bond indices earlier in 2025. There hasn't been much innovation happening in the bond indexing world for years. Many people still are using that Bloomberg aggregate index, which is debt weighted and doesn't hold a lot of bond sectors. It's investment grade focused. There's a lot of things that are left out of it. We think there's innovation that can happen in that space, moving away from debt weighting, reducing turnover, controlling risk. And so our team at VettaFi is working on some innovations that I've seen the initial efforts of. I'm really excited about. I think in 2026, we're going to see ETFs that are tied to this. And then lastly, you mentioned thematic in the beginning, and maybe we're going to come a little bit deeper since we at VettaFi acquired some pre-existing indices from Range Resources. But we also are going to be behind some ETFs that are coming to market in the fourth quarter from Rex shares that are thematic in nature. So they haven't come out yet, the ETF, so I'll probably not let compliance drag me out of here.
I do want to talk more about thematic ETFs, but let me ask you this. Do you think, as you look at different segments of the ETF market, are there areas where there is more opportunity for innovation? So you did a great job there walking through a couple on the equity side, a couple on the fixed income side. You mentioned thematics. Is there an area of the market where you think there is more opportunity? There's more white space?
So I think it's in fixed income. We've certainly seen fixed income ETF adoption be stronger in the last couple of years. Active has been a key part of that, in part because nobody believes many people don't believe the Bloomberg aggregate index is a good index. So you turn to active management because you want to outperform that. But what if you want a rules-based approach to that? We think we can help in that from a VettaFi standpoint. I'm sure we're not alone in that space. I think there's going to be a lot more innovation happening within the fixed income ETF space, and particularly on the indexing side in the next couple of years.
Yeah, I think there's a lot of room both on the index base and active side in fixed income. I've talked about that for a long time, but I do also think there's a lot of opportunity on the index base side for thematic ETFs. And so let's now come full circle and talk about the VettaFi acquisition that I alluded to earlier of Range Fund Holdings and North Shore Indices, which that brought the Range Nuclear Renaissance Index under the VettaFi umbrella. That index powers an ETF by the same name, the Range Nuclear Renaissance Index ETF, which has a fantastic ticker symbol, NUKES, NUKZ. And Todd, you look at that ETF, it has been a really nice success story. It launched in January of last year. I was looking this morning, it's already over 700 million in assets. It's up nearly 75% just this year. And so I'd love to have you talk about what makes this index and this ETF unique.
Well, it feels like you did that for me. So yeah, we're really excited to have Nukes, the index, under our umbrella and the ETF that tracks it as part of our family. There's a couple of other indices that came over with it. I know the audience has certainly heard from my colleague Zeno Mercer talking about artificial intelligence. He supports our Robo suite of products, and there's an ETF, Think, THNQ, that's a research driven approach towards artificial intelligence. We think Nukes fits in very well with it because the need and the spending for artificial intelligence has forced many people to look for a stable and cleaner way of getting reliable energy. And nuclear energy is one of those areas that people have identified as a way to be able to work. And the Nukes index is constructed in order to support that. So it's looking at companies that are tied to nuclear energy across the spectrum. You're right, we've seen strong, or we, the industry, has seen strong demand for nuclear energy and other thematic strategies in the last couple of years. We're excited to have Nukes under our umbrella and think that there's still room for growth. We're still in the early stages of artificial intelligence, as many people have been on here to talk about, and thus you want to make sure that you've got the power demand behind that. Nukes is a great way of pairing that. So we know people, and we're going to start talking to people about how an AI and nuclear index-based approach can fit well together, whether it's with VettaFi or others.
Todd, if there are some other VettaFi thematic indexes you want to highlight, certainly feel free to do so. But if we just take a step back, I'm curious because you and I haven't talked about this in a little while, what you see as the role of thematic ETFs in a portfolio, and maybe what you have been hearing from advisors you talk to, because you do have conversations with a lot of advisors. VettaFi has conversations with a lot of advisors, just in terms of how they view thematic ETFs.
Yeah, so we, as you know, we do virtual events with a range of different partners, pun unintended, saying the word range a second time. And one of the questions that we routinely are asking them is, how are thematics fitting into your portfolio? What is the exposure? How are you thinking about them? And what are some of the areas of focus? And we consistently find that people who are responding to the question, which they've opted into by joining a thematic focused virtual event, roughly 5 to 10% of the exposure of their portfolio is dedicated towards thematic investing. We find that they're usually holding 2 or 3 different thematic strategies because they want to make sure they have exposure to multiple themes. And we think this is not just what advisors are doing. In fact, you might have noticed that the ETF BAI, which is an iShares artificial intelligence thematic ETF, its assets have skyrocketed this year. It has done so because BlackRock has added BAI into its model portfolio. So BlackRock, the way that they explained it to me and in their commentary, was they chose a thematic approach to be more targeted than having a sector approach. So choosing artificial intelligence as a cross theme instead of having technology exposure as an overweight. You can certainly do that with healthcare technology. In the case of healthcare, you could do that in nuclear energy instead of utilities, for example. There's lots of ways that we're seeing people use thematic ETFs in a broader portfolio.
And again, you can do this through the lens of nukes or other VettaFi indexes if you want, but you've always been very big about knowing what you own and looking under the hood. And before I let you go here, I'm just curious, what do you think investors and advisors should be looking for in thematic ETFs? What's most important here? What are some key considerations?
So I think with a thematic ETF, there's a couple of things that I think are important. One is take the benefits of full disclosure and look inside the portfolio and see if what is inside the portfolio you already have significant exposure to. So artificial intelligence is a perfect example. The Qs is often being used, the Invesco QQQ Trust is being used for many people in their portfolio to get targeted, to get exposure towards artificial intelligence. And NVIDIA and Apple and Microsoft and the rest of the Mag 7, those companies are, in particular, were growing based on artificial intelligence. So if you already own the Qs within your portfolio, you probably don't want an artificial intelligence ETF that is overweighted and heavily exposed to those exact companies. And Dan Ives, for example, has had a very successful ETF launch this year. I know you've talked about it with some of my colleagues. The ticker is IVES. I'd love to have an ETF named after myself at one point. Maybe Nate, so will you. But Dan has done that. He's a great analyst, great expert within the space. His ETF holds NVIDIA and many of the stocks that you'd find within the Qs. So is using his ETF a great complement to the Qs, or is it better served as a replacement? I would say it's better served as a replacement, a more active alternative to it. Whereas Think, THNQ, which is the Robo Global Artificial Intelligence ETF, when I look at the top 10 holdings, I actually don't know the names of these companies. And I find that to be a good thing. That means that the research-driven approach has identified companies that can complement a broader portfolio. So IonQ, Nebius, Tempest AI. Nate, do you know these companies? I don't, but do you?
Well, I know some of them, but I like the point that you're making here in that if you're going to dabble in thematic ETFs, I actually think a really good starting point is looking at the overlap that those ETFs have with existing holdings. And I'll tell you a story. I don't put on my advisor hat on this podcast often. Maybe I should do
You
it
should.
more.
You really should.
I probably should, but I was actually looking at a prospective client statement just yesterday. And interestingly, it was all ETFs. It was, I would say, a well-diversified portfolio overall, but it did own several thematic ETFs. And if you looked at those thematic ETFs, they had significant overlap with the core holdings in the portfolios to where there's really not a huge benefit there. They could just double down on the core holdings in their portfolio or increase the exposure to those if they want that, if the underlying holdings. And so this is something that you actually see out in the wild. This is a real issue. And, I agree. I think there's a lot of different reasons to use thematics in a portfolio. I've talked a lot. You probably remember just on the behavioral side that I think allocating to thematics, let's say you take a 2, 3, 4, 5% allocation. For some clients, that can help keep them invested in the other 95% globally diversified portfolio because they feel like in that 5% thematics, they have the ability to seek some alpha. Maybe they're invested in an area of thematics that they have a passion around. So I do think there's a behavioral component. But if we put that aside and just look from a pure investment perspective, I do think that you want to really understand how that thematic interacts with the rest of the portfolio. And sometimes it's easy to just say, well, I'm going to invest in AI or nuclear or cannabis or blockchain or whatever, and you don't realize you already own a lot of that same exposure out there. So I think that's a great point. Anything else you would highlight? I know you're always big. You have to look at fees. You have to look at some of the other items that I think we always check. Anything else you would highlight in terms of due diligence?
Yeah, so I think fees are probably lower down on the scale when you're looking at thematics because ideally, two thematic ETFs are going to be quite different based on how the index provider or the active manager, in the case of Ives, is thinking about artificial intelligence or robotics or nuclear energy or healthcare technology or what have you. So I think fees matter less and looking inside the portfolio should matter more. And for those of you that are watching this, and I encourage people to watch this because it's great to be able to see Nate's face and to see us react to one another. I smacked the mic in my passion talking about thematic investing. So that's something you want to take a look at if you can see the clip.
Well, Todd, fun chat this week. I like when you get worked up like that. That's a good thing if you occasionally beat up the mic a little bit. But look, if people didn't know before, they now know that VettaFi is an index provider. So listeners learn something new every week here on ETF Prime. Thank you for joining me.
It's always a pleasure. And when I listen, I learn something new too.
That was Todd Rosenbluth, Head of Research at VettaFi.
Looking for a new approach to managing market swings? Webb's Defined Volatility ETFs seek to use a transparent, rules-based strategy that dynamically adjusts exposure to equities based on real-time market volatility. The goal to help maintain a specific level of risk while seeking to enhance risk-adjusted returns. Investing involves risk, including the possible loss of principal. Carefully consider the investment objectives, risks, charges, and expenses before investing. To obtain a prospectus containing this and other important information, please visit https://www.websinv.com. Read it carefully before investing. Distributor Foreside Fund Services, LLC. Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
I'm now joined by Aakash Doshi, Global Head of Gold Strategy at State Street Investment Management, who, of course, is one of the world's largest ETF issuers. And here in the U.S., they currently offer over 170 ETFs, some $1.7 trillion in assets. That includes the most popular physical gold ETF, ticker GLD, the Spider Gold shares. That's actually one of the most popular ETFs, period, with $130 billion in assets. And then they also offer the Spider Gold mini shares, ticker GLDM, which that has $22 billion in assets. But Aakash is obviously a gold and commodities expert, and he's now joining me from New York. Aakash, it is a pleasure. Welcome to the podcast.
Thanks for having me, Nate. And with such a great introduction of our funds, I think I can step off now.
Well, look, I was looking this morning, the Spider Gold Shares ETF, and we'll talk about flows here in a little bit, which have been remarkable. But just performance-wise, that's up 54% this year. Gold itself, as you're well aware, is right at about $4,100 an ounce. That's at an all-time record high. And interestingly, this is going to surprise some people. If you look back over the past 5 years, gold has actually outperformed the S&P 500. And so, again, a lot we're going to discuss here, but I thought let's start with the bigger picture in terms of some of the macro drivers of gold right now. Just give us the high-level snapshot here. What has been going on? Why is gold at a record high?
So there's a combination of both structural and macro factors that have really driven this gold rally over 2025, but then really over the last 3-4 years post-pandemic. So first and foremost has been physical demand. Physical demand has shifted outwards since the pandemic ended. You've seen strong retail China buying. You've seen strong central bank demand, and that's been at record levels since 2022. But then on top of that, you can overlay in 2025, we've seen very strong ETF inflows. So the return of Western investors, the return of portfolio allocators. And to that tune, we've seen the strongest inflows for gold ETFs this year since 2020, and we're going to surpass those numbers, in my view, in the fourth quarter, having seen just in the Spider GLD and GLDM suite up just about $23 billion of inflows as of mid-October year to date. So the combination of financial inflows returning to the gold market following the strong physical demand shift out of the demand curve since 2022 in particular, that has really propelled prices higher. And then lastly, I would say 2025 has been a combination of uncertainty, of a lot of volatility is related to trade policy, is related to fiscal policy, and also a lot of inflation uncertainty. So it's really created a perfect storm for gold prices to really mark up higher.
How odd is it to see both gold and the S&P 500 near record highs? Because I think many investors, they view gold as a hedge in the event, say, the S&P 500 suffers a downturn. And so I'm curious, is it unusual to see them both at or at least near record highs together?
It's not impossible, but it is unexpected and it is less usual. So let me frame that context. If you look from mid-April of this year, during the peak tariff stress and uncertainty, through mid-September, even late September, you essentially had a V-shaped recovery in the US equity market. Can't be denied. You went from a correction territory, more than 10% drawdown, to a fresh bull market in a 4 or 5 month period. At the same time, volatility across asset markets, US treasuries, equities, commodities markets broadly, FX markets, foreign exchange markets, and currencies broadly, all compressed to year-to-date lows. Yet gold during this period really hovered within 3 to 5% of all-time highs at the time, just down from 3,500 to around the 3,300, 3,200 average level. And then in late August, after Chair Powell's speech at Jackson Hole, the chairman of the Fed, you started to see the gold market rally. And in September, we actually saw record inflows for the ETF sector as a whole. And we saw fresh highs. So 3,500 was broken, then 37, 3,800, and now we've broken above 4,000, as I had expected since August. And I think a key reason for that is the drivers for equities have been a little bit of the taco trade, optimism about AI, perhaps the US growth will surprise to the upside in 2026, and really earnings momentum. The drivers for gold have been a weaker dollar, a lot of policy uncertainty, the Fed restarting its easing cycle. They cut again in September after a long pause throughout this year. So I think the factors have been very different that have driven gold prices and equity markets. What I would say is that in a normal environment, I would have expected gold prices to fall much further than they did in the summer. They were only down 3-4% from their all-time highs in April previously. And I would have expected a lot more de-risking or de-hedging of using gold. So I think the gold market is sniffing out something, that there's structural factors supporting the price here. And those might not be related just to the equity market and risk on, risk off cycles, but more structural factors is related to the dollar, inflation story, the fiscal story as well.
Yeah, let's talk more about that. I want to unpack some of these potential drivers of gold. And Akash, you publish a monthly gold report for State Street, the monthly gold monitor. And I was looking at the most recent version for October. And it was interesting. You said that gold tends to exhibit some weakness in November and December, but then you laid out a host of reasons why you believe any dip would be bought. And again, I want to walk through these because I think these are very helpful in understanding the key drivers behind gold. And some of these are obviously the same as the macro drivers you just walked through earlier. But again, perhaps we can get into more detail here. And so first, you pointed to the US dollar downtrend. And you said with the Fed resuming rate cuts and with concerns still lingering around inflation, plus the overall fiscal backdrop that you just mentioned, we still have a government shutdown. You said all of that points to a steepening of the Treasury curve, which would support gold prices and weigh on the US dollar. And we don't have to, go down the rabbit hole here, but can you just explain that in a little bit more detail?
Sure. So gold is largely traded and moves around financial markets in US dollar terms. So there's a denomination effect. So when the dollar strengthens, gold typically tends to weaken, and that can affect other commodities as well. But if the dollar is falling, gold can appreciate through those denomination effects because it's priced against other currencies and the dollar is the main one. So it's no surprise that in 2025, the US dollar had its weakest first 7 months of the year since the 1970s. In turn, gold has had its strongest return in 2025 since 1979. So I think denomination effects are a big part of it. Why is the dollar weakening, however? I think it's a combination of factors. One is US growth is not as exceptional versus the rest of the world this year. Some of that is also related to trade policy and trade uncertainty. I think there's been a real Liberation Day or post-Liberation Day impact that has weighed on the dollar, as well as foreign demand for dollar-denominated fixed income paper and treasuries. I think a third factor is you have a US administration and a White House that really is not fighting against a weak dollar. It wants a weak dollar. And you couple that with the Fed starting its cutting cycle again in September of this year, all of those factors have weighed on a weaker US dollar. And that weaker US dollar really leads to gold outperformance. That denomination effect is probably the number one driver this year. And you can see the differences across currencies. Gold has underperformed against the Swiss franc this year. It has underperformed against the euro this year, both of those currencies rallying against the dollar, but gold has outperformed against the dollar this year. So is the market telling you that we're a little bit concerned about the US economy? Are we a little bit concerned about the US debt load and the fiscal imbalance here? Keep in mind when we were talking about the equity rally, the two things that happened to support gold in that period. One is the dollar continued to slide in the second quarter and the early third quarter. That helps gold. We just went over denomination effects. But the second thing that happened is even as we were having this V-shaped recovery in equities, you had the passage of the OBBBA bill, the One Big Beautiful Bill Act. And what that conservatively does is add 3 to 3.5 trillion to the US debt and deficit over the CBO, Congressional Budget Office forecast window. So is the market concerned about that debt and that debt load in the US? And is that supporting gold as well? So I think, that combination has led to a bear steepening of the treasury curve. Front end rates have been falling, but back end rates are very sticky because of this fiscal and inflation impulse. To me, on balance, all else equal, that's a dollar negative phenomenon and a gold positive phenomenon from a market structure standpoint.
I know another factor that you pointed to in the report that could further support the price of gold, and you touched on this earlier, but it was ETF inflows, which, as you know, those have set a new record this year. I show about $37 billion so far, which that surpasses the record $29 billion in 2020. Now, of course, we still have a couple of months to go, but I think your thought in the report was that you don't see these inflows letting up, correct?
Yeah, on balance, I think gold is still an under-owned asset. It is only in 2025, and really within 2025, only in the last 6 months, that allocations have started to increase. Nate, you wouldn't believe it, but in 2024, gold was also the number one performing macro dollar denominated asset class globally. Last year, in 2024, gold outperformed the S&P 500 outright and in volatility adjusted terms. You know what we saw globally? ETF outflows. The global gold ETF market structure has experienced several years of redemptions and outflows post-pandemic. In 2022, in 2023, even in 2024, when gold really rallied. It's only in the last 6 to 8 months that the ETF inflow cycle has reversed from outflows to inflows. And I think that's done a couple of things to support the market. One, it helps the financial price of gold because you have Western investors in particular coming back into allocating for gold, but it also tightens the physical gold supply-demand balance. These are physically backed ETFs where we're seeing inflows largely. And from that standpoint, if ETFs, instead of providing supply to the gold market, are absorbing supply, then you need a higher clearing price, Econ 101, to ration other pockets of demand. So if the central banks are still buying, if China retail is still buying, even if both of those pockets are a bit slower than they were last year, the ETFs have surged so dramatically that overall, it requires a higher market clearing price for gold. Hopefully that's not too technical, but it's kind of almost an Econ 101, right? You have a supply curve and a demand curve, and if the demand curve is really shifting outwards, you need a higher equilibrium clearing price for gold.
No, I think it makes perfect sense, and it's interesting because listeners of this podcast know that over the past several years, I was pounding the table saying that we would see these inflows into gold ETFs. And the reason, Akash, was that gold was performing so well. And typically in the ETF space, you'll see flows follow performance. But for whatever reason, we weren't seeing that. And so now it almost feels like these record flows that we're seeing into physical gold ETFs now is almost like a catch-up trade to what we would have expected over the past few years.
Absolutely. You're paraphrasing my October report, but I completely agree. It's a catch-up trade. And if you really look over the last $300 move, let's say from 3,700 to 4,000, now we're at 4,100. I would say the last 300 to 400 is not just a catch-up trade. There's also a bit of FOMO in the market, fear of missing out. We often see that in tech stocks. If you're talking about NVIDIA or Tesla or Facebook, now Meta. However, I think this year in particular, we didn't see it in 2024, but in 2025, there's a bit of FOMO, fear of missing out on the gold trade and this global alt fiat or global debasement trade as well.
In terms of physical gold consumption, you just mentioned central banks and China retail demand. I know you also noted those in that October report. Any quick comments on either of those?
So 2025 will be the 16th consecutive year, Nate, after the global financial crisis where central banks are net buyers. And dare I say 2026 will be a 17th consecutive year. This is important because central banks are geoeconomic and geostrategic buyers. They're buying gold not to return alpha for 2025. They're not looking to make outsized returns in a 6-month, 12-month context. They're not active traders. They are holding for 5, 10, 20-year horizons for political reasons and policy reasons. And it's part of a broader de-dollarization trend. It's a part of a broader reserve diversification trend. So not only do I think the central bank buying has been the most important factor for gold over the last decade and a half since the global financial crisis, I think there's legs in this environment for them to keep buying over the next 5, 10, 15 years. That's number one, because if you go back before the global financial crisis, it was almost 40 years of net selling after the Nixon shock in 1971. Not every year, but pretty much 8 out of 10 years following the Nixon shock, they sold for 4 decades. So that's a big structural shift, very important. Central bank demand still very strong in 25, down from the records, but very strong. The China retail story is also equally important because China retail over the last 3-4 years has bought more gold than the entire central bank system globally. People don't know that, but let me repeat that. China retail, not the PBOC, China retail, non-monetary gold demand has been higher than all global central bank purchases of gold every year for the last 3 years. That's critical because that's providing idiosyncratic support. China consumers are not buying gold because of what the Fed is doing. They're not buying gold just because of risk on, risk off cycles and where the S&P 500 is. That's providing idiosyncratic support against their own local economy, their own currency, their own property market weakness and concerns post-pandemic and so forth. So I think that combination of physical demand from China retail, India retail, I would add, has also been strong. They've had some tax reductions there that has increased demand. Growth is good in India. You combine that with the central bank story and you overlay the financial demand on top of it, you set up a record year for gold.
That's an absolutely remarkable stat regarding China retail demand. I hadn't heard that before. Relative to central bank purchases. I don't think a lot of people are aware of that. Let me ask you about 2 other potentially supportive factors for gold. And again, you noted both of these in that report. One was stagflation risk. And you said gold had historically outperformed during periods of slow economic growth and high inflation. And Akash, I guess my question here is, do you see a stagflationary environment as the base case, or are you just saying that even the potential of stagflation is enough to further support gold?
When we look at the world and we think about portfolio allocation, it's about balancing risk and reward and thinking about the outcomes. So even if you don't think, and I personally don't, that stagflation is a certainty and a base case, if the probability distribution of outcomes widens and the modal probability of downside risks for the economy increases, then that should really benefit alternatives and safe havens such as gold. So what does stagflation mean in very simple terms? It means growth is slowing, the labor market is weakening, and inflation could be sticky, could be higher than normal or higher than target. When was the last time we saw this? The 1970s. So it's no surprise that gold rallied the most in the 1970s in history, in the modern era, in the free floating US dollar era. And we're seeing some echoes of that. In fact, my October report was titled Echoes of the 1970s for the monthly gold monitor. And I think that's a very important point, which is if the risk of higher inflation, a weaker labor market, and slower US growth, if that just the risk of that is higher, then that impacts sentiment and that impacts allocation. Doesn't mean you have to head there, but the modal probability to me seems higher than it was 12 months ago into the US elections. And it seems higher than 9, 10 months ago at the beginning of this year. In fact, I think it's not that long ago, but time moves so fast, it's hard to remember. But January, February of this year, there was a lot of enthusiasm. I think we all remember how the S&P 500 did after the US elections last year. There was a lot of optimism about deregulation, earnings, AI, and so forth. A lot of that still maintains, but now you're starting to see cracks in the labor market. You're starting to see the Federal Reserve itself, in its summary of economic projections, lower the growth outlook, increase the inflation outlook, increase the unemployment rate outlook.
Well,
That
and I
is
think
stagflationary.
I think that's well said, and really all of that gets into the last factor I want to ask you about, which I would say is sort of a catch-all, but it's really the way a lot of investors think about gold, and that's that there is this uncertainty premium for gold. That to exactly what you were saying, if you're expecting a wider range of outcomes economically, or perhaps on the inflation front, or politically, foreign policy, gold should continue to benefit. That makes complete sense to me. Anything you would add regarding the uncertainty premium for gold?
Just geopolitics. The world under the current political climate, Vox Populi movements, a lot of governments falling across the pond, a lot of changes in structure, that leads to a lot of uncertainty. And that uncertainty premium, as I define it, is separate from market volatility. As you know, Nate, as I mentioned earlier at the beginning of our conversation, volatility actually collapsed over this summer. We felt a year-to-date lows in volatility across asset markets in July and August this year. But what does that uncertainty premium mean? It means more structurally, what is the inflation outlook over the medium term? Are we ever going to get to the Fed target, or are they going to increase the target to 2.5%, 3%? And 2% is kind of a pre-2020 notion. What is the outlook for geopolitics and the various conflicts happening in various theaters across the world? What is the outlook for trade policy? We saw last week, we're speaking in mid-October, but we saw in the first week of October how trade tensions between the US and China have potentially ratcheted up again. So within that context, when you have a lot of those embedded uncertainties, I think gold is your traditional low volatility, safe haven, left tail portfolio asset.
All right, you use the word traditional asset for gold. I'm going to sneak in a question here, which maybe this will surprise you, maybe it won't, but I have to ask you about Bitcoin, which is often referred to as digital gold. I'm very curious how you view Bitcoin relative to gold. Like, do you see Bitcoin benefiting from any of these same factors that we've discussed here today? Is Bitcoin in competition with gold? How do you view Bitcoin relative to gold?
So first and foremost, I have to apologize to my advanced placement English teacher from high school. I should have made traditional an adverb and said traditionally a safe haven asset. But yes, it is a traditional. It's old, historic. It goes back. Gold goes back to biblical times. It was a gift from the three wise men. So let's be honest. It's one of the oldest assets that we think of today. But within that context, and our team has just published a paper on Bitcoin and gold and how both can fit into a portfolio. I would posit this, Nate. If we were speaking even as recently as 3-4 years ago, but certainly before the pandemic, gold bugs and Bitcoin bulls would be clashing. They'd be fighting each other. I think what you're increasingly seeing and this is evident in 2025, is that both can coexist. And that was the purpose of our paper. Where gold is more of a left tail hedge, something I made in my last comment, something you said, kind of what do I mean by left tail hedge? Kind of a tail risk of growth slowdown, geopolitical uncertainty. It's your low volatility asset. Bitcoin can be your right tail. It can add or juice returns over a long horizon, has that return potential, but it adds a lot of volatility to the portfolio. So the combination of both, actually, what we found in a traditional 60-40 or 70-30 portfolio, adding both gold and Bitcoin towards those allocations can actually reduce overall drawdown risk. It can reduce portfolio volatility and actually provide better returns over the long run. I will say, honestly, over the last couple of years, because gold has also performed so well, you're seeing a little bit more adoption and kind of cohesion between these alternative fiats or global debasement assets. What I will say is I don't think they're the same. Gold is different. It's lower volatility. It's owned by central banks themselves. It has a lot of dynamic or diverse sources of demand: jewelry, electronics, investment, so forth. Bitcoin, let's be honest, is primarily for investment purposes. So there are differences between the two, but I think they can coexist. And in fact, the title of our paper that I led was how Bitcoin and gold can coexist in a portfolio.
All right, a few minutes left here. Let's briefly talk about gold and gold ETFs in the context of a portfolio. And first, on the ETF side, obviously products such as the Spider Gold Shares GLD and the Spider Gold Mini Shares GLDM, these are very popular ways for investors to gain exposure to the metal. And you look, GLD has now been around for over 20 years.
21 years.
21 years. But there are other physical gold ETFs on the market, as you know. Anything in particular that you would highlight specifically with GLD or GLDM?
If you look at the combination of GLD and GLDM, they are not only the largest precious metals or gold-backed ETFs in the world, they are the largest commodity funds in the world. So when you look at both of those tickers, and you have GLD, which is the market leader, and then you have the mini shares, GLDM, which you mentioned earlier, Nate, they are liquid products. They are transparent 1933 Act products. GLD controls 98% of the gold ETF options market. So if you want to do options overlay strategies, that's a huge advantage. They're active in the securities lending market, and they have a very low transaction cost. A lot of times, Nate, people come up to me and they're like, why not just own the physical gold? Put it under the mattress, put it in the safety deposit box, etc. The reality is, if you're having a very small amount, sure, fine. But if you're looking at a financial portfolio and you have real allocations to gold, which should be there, then you have to pay a very expensive transaction cost for physical gold. You have to pay for vault storage. You have to pay insurance. So there are a lot of embedded costs there to having that physical gold exposure. I think the ETFs are a very simple and transparent and very efficient way to get gold physical exposure at a low transaction cost. And I can go into more details, but I know we're limited on time. But I would just really highlight the ETFs broadly are a very strong way to get exposure to an asset class.
All right, let's put a bow on our conversation here today by really honing in on the role of gold in a portfolio. And obviously, Aakash, we've touched on many of the key drivers of gold. But if we just take a step back here, how do you think investors should view an allocation to gold? Because I feel like this does still seem to generate a lot of debate. I think gold is still very polarizing for whatever reason. And so if you were to summarize this, why own gold as part of a diversified portfolio?
First and foremost, to add diversity. You want an asset that's low correlation to other portfolio constituents. And over the long run, what you could see with gold is a very strong negative relationship with the dollar, and it has a very low or almost no correlation to equities and bonds over the very long horizon. So that's first and foremost. You want it for diversification. Two, I think you've just framed gold and just broader alternatives in a context where it's 2025, Nate, right? 60-40, 70-30. equity versus bond, that doesn't work anymore. And particularly since 2022, when stock bond correlations have surged to multi-decade highs. Are you getting that same protection from 10-year treasuries or certainly long bonds, 30-year paper, that you were historically? And my answer to that is that's more questionable, largely due to those factors we were talking about earlier related to the dollar and treasury curve steepening and the inflation and fiscal outlook. So within that, gold is a traditional asset that has been a safe haven, but is now providing duration hedging and portfolio diversification attributes. So I think gold should be viewed in a broader alternatives context where it's not 70-30 or 60-40, but we might be thinking more 55-25-20, where 20 is an alternatives bucket of which gold has its own sleeve of 5-7%. The last point that I would make is that over the long run, gold actually has capital appreciation. You might be surprised to learn, Nate, since 1971 and the Nixon shock and the US exiting the Bretton Woods system, gold has had average annual returns of 7-8% in nominal terms and 3-4% in real terms. That means gold is outpacing cash plus inflation.
Well, Aakash, I have to tell you, I think we packed more into 25, 30 minutes here on gold than has ever been done in history. Excellent perspective this week. I really enjoyed the conversation. This has to be a fun time for you right now with gold at record highs. But thank you so much for joining me.
It's my pleasure. It's been busy, but it's a lot of fun, like you said. And I look forward to the next time we get to have a conversation. And I hope all the viewers will enjoy this.
Well, thank you. That was Aakash Doshi, Global Head of Gold Strategy at State Street Investment Management. That'll do it for this week's ETF Prime. I'm excited to tell you that I'll be at Exchange 2026, where I'll be taking the stage and even recording a live episode of ETF Prime. So this is your chance to join me alongside a community of top advisors and industry experts for a few days of world-class content and unparalleled network. You can secure your spot today by visiting exchangeetf.com. Next week, I will be joined by Franklin Templeton's David Mann and Azoria's James Fishback. This should be two excellent conversations. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.